Staggs was elected president of ArrowMark Financial Corporation in June of 2022. He joined ArrowMark in June of 2017 as a member of ArrowMark's Private Capital Solutions Group, where he sources, structures, manages private debt, and non-controlled private equity investments. Prior to joining ArrowMark in 2017, he worked in similar capacities at firms like Goldman Sachs, Barclays, Private Credit Partners, and GE Capital. And Mr. Staggs previously served 10 years as a surface warfare officer in the U.S. Navy, having attained the rank of lieutenant commander, and earned a Bachelor of Science degree in physics from the U.S. Naval Academy and an MBA from the Mason School of Business at the College of William and Mary. So, Danny, great to have you here. And
thank you for having me.
Chatted a little bit before. We talked about how I don't know much about regulatory capital relief securities. So I'm curious to learn about this. So give me an overview. What are these?
Regulatory capital relief securities, they're a private security that are issued by banks. And so from an investor perspective, I think investors find this attractive because they have a relatively stable asset profile. They're generally uncorrelated with a lot of other asset classes, and they've got a lot of high income generation potential. So as I mentioned earlier, they're issued by banks, but they're typically the larger money center banks. So think of these as your household names like Citigroup, Goldman Sachs, or Barclays Bank. They have maturities that are about 5 years, but they start amortizing between 3 to 5 years. And the coupon on these are floating rate, so they're a spread over a floating rate index like Euribor or SOFR. Today, they're probably yielding somewhere around the mid-teens area, so quite yieldy.
Yeah.
And very attractive for what I would think are income investors.
And these really came about after the financial crisis, when banks started having more regulations. We had all the stress tests, things like that. So this kind of was born out of that, right?
It has, and it has definitely evolved through that time period. If you think about what the banking sector looked like pre-Great Financial Crisis and compare it to where it is today, our view is that the banking sector is a much healthier sector. Mm-hmm. And that is a byproduct of what would be increasingly strong regulatory oversight and more specific restrictions on how the banks manage risk. So as a result of that, what ended up happening is the regulatory capital relief security was born out of that, and it provides the banks a tool to help them manage the risk, especially as they look to managing the risk that the regulators want to oversee.
And the risk does, I guess, go to the investors.
That's right.
But they are rewarded with that high coupon, as you mentioned.
That's right. And so the way I would think of it is there's, the banks use this as a means to transfer the risk from a high quality portfolio of loans. Think of these loans as anywhere between several hundred to over 1,000 loans. They're typically on a risk dollar weighted average basis around BB positive to BBB minus. So these are the stronger loans within those mm-hmm. portfolios. And so they're able to risk transfer some of the risk from themselves to us. Our investors get exposure to what I think are very high quality loans. But the benefit to the banks themselves is that they maintain the customer relationship. And the customer relationship is what I like to think of as the lifeblood of what these money center banks do. They are able to cross-sell and upsell into these customers through these customer relationships with products like the treasury management services, the corporate credit card program, investment banking services, M&A, so on and so forth. As a result of being able to transfer the risk, but also maintain that customer relationship, there's a value add to this security that you don't see in something like a corporate bond, a typical corporate bond, where there's this natural tension of trying to get the best return for your investors while the issuer is trying to get the best cost of capital for themselves. In this particular case, mm-hmm. it's a tool that helps them solve some balance sheet risk difficulties that they may have, and as a result, our investors get paid a premium to what I think are more commoditized asset classes.
Yeah, that's really the incentive for the buyer and the seller. So they move that risk somewhere else. The buyer gets, as you mentioned, the high interest rate. Are all size banks able to take advantage of it? You mentioned some of the big ones. Would a mid-sized or regional bank be able to do this?
They are capable of doing it, but most of the issuance today is done through the larger money center banks. And frankly, a lot of them are the globally systemic important banks.
Mainstream investors can access this through a fund.
That's right.
Tell me about that you manage, right?
Yeah, so historically, this was primarily a product that was offered to institutional investors. So, when we started doing this in 2010, we were generating good returns for institutional investors using this product. But in 2020, early 2020, we acquired the management rights to this closed-end fund that trades under the ticker BANX. It's ArrowMark Financial Corporation. And through that vehicle, we have today about 87, 88% of our total assets are in regulatory capital relief securities.
Mm-hmm.
So retail investors can get access. As far as we know, this may be the only way that the typical retail investor can get meaningful exposure in this product.
And how have the returns been?
Returns are very solid. Just to give you a few data points, I mean, right now, I think our distribution yield, if you use the 2023 numbers, are somewhere between 9.5% and 10% based on our share price today. We moved our dividend from 38 cents to 39 cents. So the first 2 quarters of last year, we were at 39 cents, and then we moved it up again to 45 cents and 45 cents. So all of 2023, we had $1.78 of declared distributions plus a 10-cent special. We've out-earned our distribution since we've taken over this fund. And in Q4, just by way of an example, we had 67 cents of earnings per share relative to the 45 cents of declared distribution. So very strong income generation. I think that the average yield I mentioned, but kind of mid-teens area, I think in our portfolio, our average yield at the end of Q4 was somewhere around 14.6%.
Okay, yeah.
That's before any kind of interest expense or fees and so on.
And you mentioned there's not a lot of risk in these, so that's a good return for not a ton of risk to take on.
We do think it's asymmetric risk. And so just to sort of break down the risk profile on a issuer counterparty basis, what you're facing is the risk of the senior unsecured creditor class for a bank like Citigroup or Goldman Sachs. Sometimes these even have credit enhancements, like you may benefit from some depositor creditor class protection. So very high up in the capital structure. Their performance are indexed, though, to a portfolio of loans. So think of it again as the 200 to over 1,000 loans that are diversified by issuer, geography, and sector. And so the way the regulatory oversight works today is the higher quality loans are the ones that we find that the banks are typically looking to risk transfer to us. And again, like I said, BB positive to BBB minus.
That's interesting that they would want to offload the higher quality loans.
I think it's a byproduct of the fact that the higher quality loans don't yield as much. And the amount of capital that they have to allocate against those are expensive.
So you kind of have a front row seat to the banking industry.
Sure.
Is it healthy? I mean, you mentioned healthier now than pre-financial crisis. How do you see things? We've dealt, with interest rates, inflation. How do you see the industry right now?
We do think that the banks are, as a sector, in a very healthy position, especially relative to the great financial crisis. But you can dial the clock back and even look in early 2023, Q1 and Q2, you saw some hits with some of the regional banks. We saw Silicon Valley Bank, we saw Signature Bank and the issues that they face. But we view those as more idiosyncratic issues with those banks, primarily driven by a very rapid rising interest rate environment and the interest rate sensitivity that they had in their portfolios. But when you look at the issuers that we're managing, that we're investing in, these are the globally systemic important banks and the large money center banks, which are in a much, much healthier position today. But even if you see some spillover going forward with whether it's commercial real estate or some other shock, we do think it's isolated because the regulatory bodies globally have done a very good job of making these banks healthier over the last 12, 13 years.
Yeah. How long has ArrowMark been investing in this sector?
Yes. So ArrowMark Partners, through one of its affiliates, is the advisor to BANX. But ArrowMark Partners has been investing in the sector since 2010. To date, we've put in about $7.7 billion of assets into the sector. We've done over 100 transactions, and as a result, have a very established track record. It was when we took over BANX at the beginning of 2020 that allowed us to offer to the retail outlets, the retail channel, this investment product that has been traditionally offered to institutional investors like your pension funds and your high net worth and family offices.
Dana, thank you so much for coming in. It's great to learn about this.
Thank you for
Thanks.
having me. I appreciate it.